it was great in theory because it truly was intended to protect consumers, against predatory lending practices. But the impact to credit unions and smaller community banks was huge.
In the past decade, community financial institutions have been heavily impacted by regulation, particularly Dodd-Frank coming out of the Great Recession. One of the more impacted areas has been home lending and the mortgage lending operations. To talk to us that today, we have with us Miriam Mitchell. Miriam's the Chief Lending Officer at Addition Financial. Addition Financial is a credit union in Central Florida with just under $3 billion in assets. She was very instrumental in both the credit union and the industry with the application of Dodd-Frank and the results to that. Miriam, thank you for being with us today.
Thank you for having me.
So I think like the best place to start is to kind of take us back to the beginning of this time period, back, about the 11, 12, right when there was kind of like the shakeout of a lot of the bank failures and what happened. Kind of where were you? You were still with Addition at that point, right? You've been there for
Yep.
18 years. Is that correct? Okay.
Yep. I was with Addition.
So paint us a picture. What was that like? And, as the regulations started to phase in, what was that initial response to?
Yeah, so initially, we were in a booming economy and house prices were accelerating rapidly. We had many lenders that were doing unethical lending practices, which is what led to the Dodd-Frank Act. There were no doc, low doc mortgages, there were option arms, and that unfortunately forced a lot of homeowners into foreclosure, which led to Dodd-Frank regulation. Dodd-Frank regulation, it was great in theory because it truly was intended to protect consumers, against predatory lending practices. But the impact to credit unions and smaller community banks was huge because it was such a regulatory burden to be able to implement all of the things that fell under Dodd-Frank. For example, at Addition Financial, we actually had to go out and purchase a brand new loan origination system because the system that we had at the time was not capable of complying with the new compliance regulations to be able to produce the disclosures that we were going to have to produce to consumers. So we not only had to spend money, we had to take money, away from our members and go out and purchase a new loan origination system to be able to disclose properly, but it also took time to train. It took time to make sure that disclosures were prepared properly. And it truly was a burden, for the credit union, especially because we really did not contribute to the financial crisis. We had practiced good lending practices all along. We didn't do many of the things that the larger retail banks did that led to the housing crisis. But we did ultimately have to pay the price for it.
So there was an awful lot of carve outs. They always have like that regulatory $10 billion in assets, that magic line, right, above and below. Even with that in there, that was still something that, was a significant burden for you to lead the bank through at that time.
Yeah, it definitely was. A perfect example is you typically do have carve outs for smaller institutions, but one of the specific pieces that fell under Dodd-Frank was the combining early disclosures on mortgages and closing disclosures. So pre Dodd-Frank, you would provide a good faith estimate to a borrower, some other early disclosures. They were separate disclosures. The programming was in our system to take care of that. Post Dodd-Frank, we actually had to combine the disclosures, and it made sense because it was intended to allow consumers to have the same disclosure regardless of the financial institution that they were going to. They could compare apples to apples to make sure that the pricing was the best pricing, the fees were the best. But we weren't exempt from that. So we had to have that same disclosure that large banks had, and that was a huge burden on our financial institution.
One point I'll make on the system piece, and this is more relevant today, right, has been the consolidation of mortgage origination by ICE, International Continental Exchange, which it made it into Congress, right? What they were going to do and making them divest certain interests. So there's an anti-competitive at least focus on that part of the system, and like the requirements that so many financial institutions are now having to purchase from a relatively, you could argue a single vendor, right, to provide this in there. So, okay.
Yeah, and it is challenging. I mean, there aren't a ton of vendors to choose from to begin with, and so looking to make sure that you're partnering with the right one to be able to provide the best service and ensure you're in compliance is huge for organizations.
So was there anything unique or special, or I guess unique would be the right way to say, about like the housing market in Florida, particularly Central Florida, where your footprint is? Um, did that present any like different challenges or anything that you were dealing with? Because we remember during the blow up and the CDO meltdown, like it seemed like Orlando and Las Vegas were kind of like the two ground zeros of the biggest problems.
Yeah, so Florida was considered, a sand state during that time, and so that's kind of where you're looking at Nevada, Florida, Texas. There were certain states that were truly impacted. We saw values decline tremendously. I think Florida was probably one of the states that had the largest decline in values for homeowners. And so that obviously led to a lot of foreclosures. We as a credit union worked really hard to try to keep our members in their homes. We implemented many different programs. We partnered with the government on the Home Affordable Modification Program to really try to make sure that if we could keep these homeowners in their homes. We saw borrowers that had taken out huge equity lines of credit. And so we kind of went from a standpoint of giving money, on home equity lines of credits to now
Mhm.
having to mitigate that risk and actually reducing lines of credit to make sure that, we could do our best to mitigate any losses that we would potentially have. But yeah, we definitely saw the values decrease rapidly here. I will say that when things started to turn around, we're in a much better position today. Values have come back almost to the opposite side of the spectrum, to where now it's very hard for people to purchase a home in Central Florida. Years ago, a starter home would be, $150,000. A first-time home buyer could get into that home. It would be a reasonable payment. Now we're seeing that number is more of 250 to 300,000. And then you combine that with the high mortgage interest rates that we have today. It's almost impossible for the younger generation to get into their first home today.
So a big flip on that was obviously around the pandemic and like kind of this mass migration that happened, particularly
Yep.
from like higher tax states. I think your
Yep.
your your state's like new celebrities resident in Jeff Bezos there.
Yeah. Yeah.
He says he
Everybody.
loves his dad, but man, $600 million in tax savings, that sure is a sweet adder to that whole thing. But yeah, so like you saw a big influx of people who were meeting what became an increasingly tight real estate market, correct?
Right. Yeah, we had tons of people relocating to the state of Florida. At the end of the day, it's not a bad place to be, right? Who doesn't want to live in Florida? But that poses challenges for people that are coming here, or people that are native Floridians that are just looking to, buy their first home. You're now competing with people that are coming from New York. They're selling their homes up there. They have the cash to come down here and buy these more expensive homes. But your average, I think of a teacher, for example, that works here in Central Florida that's making $50,000 a year. It's a struggle for those types of consumers to actually purchase a home.
And now the other angle here, as far as cost of home ownership, is insurance. And Florida has always had like a unique place in the world from that standpoint. What challenges does that present for you and your members today?
Yeah, insurance is a huge issue for us right now. Homeowners insurance, we are seeing it double and sometimes even triple. A lot of our existing members are calling us. They're struggling, because their mortgage payment is going up due to their escrow, their homeowners insurance increasing, and they're struggling. They're calling us and saying, I have to do something. I can't afford my mortgage payment anymore. In some cases, they're choosing to let their insurance go and take a forced placed insurance policy, which ultimately doesn't protect them at all. It just protects the credit union's interest in the loan. So it is definitely a challenge. It's something that I think that our government is really going to need to do something about in the state of Florida, because if we don't get it under control, it's going to be nearly impossible for people to keep up with the high increases year over year.
So is that a state or a federal issue?
I think it's a state issue. I think that there are things that our state could do. We're seeing insurance companies leaving the state every day, and it's not just on the homeowner side, it's also on the automobile insurance side. It is just a huge issue. And when I talk to some of my peers that work at financial institutions in other states, they don't seem to be having the same issues that we have here in the state of Florida. And I understand, we live in a state where we're prone to hurricanes. We've had a few major ones over the last decade that have definitely impacted insurance rates. But I think that something needs to be done to make sure that we can sustain homeownership for people in the state of Florida when it comes to having a reasonable insurance policy that they can afford.
So is this kind of issue about, both the asset cost and also the cost of ownership from insurance, taxes, et cetera? Is that limited to mortgage, or do you see this in other parts of your portfolio?
So mortgage, and then we are seeing it in our auto portfolio as well. We're seeing a lot of consumers that take out an insurance policy to get their automobile loan, and then they cancel it after they have the loan because the policy is too expensive to maintain. I've talked to a few people recently that have told me that their insurance, went from paying $1,000 over a 6 month time period to paying $3,500 over a 6 month time period. Which is that's a huge expense. And we're already in an environment where the cost of living is already high for people. Everyday living expenses are increasing. So you double and you triple automobile insurance. Consumers are having to make the choice between, do I buy groceries or do I pay my insurance bill?
So what are you doing as kind of their primary financial institution, as a credit union? Like how are you helping your members through this? Is it programs that you do directly? Is it through lobbying, through trade groups? Like what's your approach?
Yeah, so on the mortgage side, we are really trying to work with the borrowers. First, we're really educating them on the fact that they do not want to go with a forced place policy. We need to try to help them find the most affordable policy that is available. And then in many instances, we're changing the way that we handle their escrow analysis. So allowing them maybe to spread that increased cost over a longer period of time so it doesn't inflate their payment as much as it would if we were making them pay it off in a 12-month time period. So that's what we're doing on the mortgage side. On the consumer side, we really are just trying to educate them. There's not a lot that we can do when it comes to the consumer side because their insurance isn't part of their loan. They're paying that outside of their loan agreement. In the event that they choose not to have an insurance policy, we do have our own insurance policy that we would place on the vehicle. So in the event they got in an accident, hopefully the collateral would be covered, but it doesn't provide them any coverage as a driver of the vehicle. It's more just a collateral protection insurance. So those are some of the things that we're doing to try to help at least curb some of the losses, because at the end of the day, on the automobile loans, if they don't even have a collateral protection policy and they get into a wreck, they're liable for the full loan balance at that point. At least with the collateral protection, hopefully we could alleviate some of that loss that they would be responsible for paying us back if they were to get into an accident and total the vehicle.
And probably avoid like a personal bankruptcy or something at that point, right? I mean,
Exactly.
it would be
Yes.
significant enough. So
Yeah.
do you have partners in in insurance, like anybody you like steer them towards or direct them, or partners you bring in, or is this something you've considered getting into the business yourself with?
So we do not have any partners that we direct anyone to specifically, but we do have a few different agencies that will bring in more for education, to try, like seminars and stuff to try to educate consumers on insurance. But we don't specifically direct anybody. We have looked at insurance in the past, as there are a lot of credit unions that actually own their own insurance QSOs. So they come together and they create, an insurance, or they have an insurance company to provide those services to their members. We looked at it one time. There's a lot of work and a lot of regulation around it, so it's not something that we've pursued at this point. But it's something that could be on the table in the future for sure.
Beyond the kind of mass movement of people, particularly in the past 3 or 4 years, what else is going on from a trend standpoint? Like how is maybe what the expectation of your members, how has that changed more of recently, and how are you responding to that?
Yeah, so I think we're seeing obviously a lot of change in the digital space. So there's a lot more demand for members being able to access us whenever and wherever they want. The pandemic actually caused us to have to actually accelerate that a little bit. Pre-pandemic, we had a great digital experience, but we weren't as focused on it as we are today. During the pandemic, we realized that we really needed to make sure that members are able to get to us, whether they can come into a physical brick and mortar branch or, via their phone, online. So we really are putting a lot of emphasis on the digital transformation and trying to bring the best experience to the Addiction Financial membership. I think also as we
And
see
is that largely like they're pulling that from you? That's a demand that you're getting from members?
Yeah, we've surveyed our members, and they definitely want to see a more enhanced digital experience. And so that's something that we're actually working on right now. And I think just the flexibility, right, of being able to do banking where you want to bank, having that ability to go out to dinner and have an app on your phone where you can instantly transfer money to, someone to split the bill, or being able to get a digital credit card issued instantly and not having to wait 7 to 10 days for a plastic card to come in the mail. You have it as to apply and you're able to start using it instantly. And these are the things that, the younger demographic is really wanting as well. I will say, even though they want a digital experience and they want access, on demand to products and services, there is still a huge need and a desire to come in and talk to people face to face in our branches. We heard after the pandemic from our members when we had to close our branches for a period of time that that's important to them. When they do want to sit down and have a conversation, it's important that they have a place that's close by that they can go and they can have that face to face interaction with our team members.
And you still maintain what, several dozen branches at this point?
We have 26 branches, yeah, across
26 branches, and then you also have a partnership with a grocery store chain, right? The Publix chain with ATM presence.
Yes, ATM network. Yep. So our members can utilize any of the Presto ATMs.
And no plans on changing that going forward.
No,
like you're not okay.
No,
which is to say that what you just said, coming in and being able to talk, that's still something that has not changed from a customer requirement. Even though you're making an investment on the digital side to add to what are convenience features or convenience-driven features, still having the physical footprint, that's still part of your strategy.
It is. Yeah, it's really important to who we are, and it's important to our membership as well. So we continue to talk about branches and, future branch locations. I think back, over all my years in the credit union industry, and there's always been talk about, will branches ever go away? Will they eventually be a thing of the past? And we do not think that will ever happen. I mean, the footprint of the branch might change. It may get smaller. We look at it more as a consultative approach with the branches, less transactional, but more for when members want to come in and they want to have that conversation about buying their first home or getting their first credit card, or a business owner wants to come in and talk about starting a business account. Those are more of the types of interactions that we see happening in our branches in the future, and less of the teller line transactional type of interactions.
So what's on your agenda going forward now that we're kind of in this post whatever period? What are you thinking about as far as growth, or where you kind of see, if it's just the mortgage part of the business, like where that's going in the future?
Yeah, so we are definitely focused on always trying to improve our products and processes. Like I said, we have a huge digital transformation that we're working on for our online banking and mobile banking platforms. We also are focused on really trying to improve service time. For example, on our lending area, we are integrating more of AI technology to help us make better lending decisions, faster, more efficient lending decisions. So those are some of the things we're working on currently, really just to try to improve and expand what we already offer.
Great. So again, still around that consumer convenience, like what they're looking for as far as making services faster or less friction in the
Yes.
process. Okay,
Yep.
got it. Well,
Um,
go ahead.
yeah,
Sorry.
definitely just, more efficient, and trying to reach more members as well. A lot of the things that we're doing around automation and AI is trying to be a more inclusive lender. So making sure that we provide access to credit to all types of people and the types of credit that they need. And I think that we are going to see a lot of advancements in that over the next couple of years.
So is that largely like a market share play, or are you looking to expand geography wise?
Right now it's just market share, so primarily Central Florida. We kind of serve that central part of the state of Florida. So really trying to just have more outreach in that area.
Got it. Well, this has been great. Thank you for sharing your perspective, particularly on the legislative side. If anybody's interested more in you or about Addition Financial, where can they go?
Yeah, so you can find Addition Financial at additionfi.com. Like I said, we're also, 26 branches in Central Florida. And you can find me on LinkedIn, Miriam Mitchell.
Great. We'll put links in the show notes. Thanks again, Miriam. Thanks for being here.
Thanks so much. Have a good one.